everyone. Hi Sam.
Hey James, what's up? How are you?
Good, very good. How are you doing today?
Yeah, I'm fine, thank you. Like, what's the weather like in Lagos before
It's
I say
um it's
anything?
it's really sunny. It's really sunny here. But it's a good weather, very sunny. How is it over there?
Okay, okay. It's really hot. All right. It's like 30 degrees right now in London,
Wow.
and it's so crazy. I'm literally sweating. You can see perspiration on my face. Like,
Yeah.
yeah, it's insane. It's insane. Well, I like it.
Great.
Yeah.
Yeah. I think it's great that we are finally doing this on camera. Like we've been doing audio for a very long time. So I think
Yeah,
it's
yeah,
great.
like
Yeah.
it's yeah, I don't know how it's going to like how our audience how they're going to like respond to it, but yeah, this actually looks good. Seeing your face,
Yeah.
seeing my own face as well. Yeah.
Yeah. So yeah, I think we can jump
So what have you
in.
been up to? Like it's been a minute. What have you been up for the past 2 weeks?
I mean, basically the same thing, like work and still doing sports every day, every week, mostly tennis and frisbee. But that's it. That's it, actually.
Yeah. I still don't understand frisbee. Like you guys just throw stuff around and run around like kids. I see
It,
adult people played that game. When is there a competition for it? Is there like a league or something? You guys?
yeah, there's like a championship, like a global frisbee championship. Um,
Ah, wow. Okay.
Hopefully, we'll represent Nigeria one day. Hopefully,
Oh,
yeah.
okay. No worries. No worries. That's okay. For me, my week has been crazy, right? So just work and yeah, I have an announcement, right?
Okay.
I recently joined Startup Grind London. So
Oh,
for those
great.
that don't know, I used to be a Startup
Yeah,
Grind chapter lead back in Nigeria in Ife, and it's really
yeah,
amazing, right? That's literally what's cut my teeth into tech, like meeting other people in tech,
yeah,
startup founders and the startup community. So it was like a great opportunity to join Startup Grand London team. My teammates are really amazing people that have been leading
yeah.
different startup ecosystem in their respective fields. So yeah, I'm really excited about that one. I joining the ship, and yeah, looking forward to the future.
Yeah, that's really a good one, actually. That's really a
Thank
good
you.
one.
Thank
Congratulations
you.
once more. So yeah, I think we could jump on board and talk about the, the topics on our deck today. And I think it's
Yeah.
majorly around like public markets, right? And a lot of
Yeah.
actions happening there, a lot of IPO news, and which is kind of like a great revival for the tech ecosystem and for the economy writ large. Like it shows that there's liquidity entering back into the system. I don't know where it came from, but it's entering back into the system. So it's great. Like, and I think the biggest IPO that has been in the talk, it's ARM, and I think we probably the ones that don't have any idea what ARM does. ARM is they design chips. They're not really like TSMC and Samsung that can like make chips, but they can like design the chips and they sell that design as license to phone companies like Apple, Samsung, Nokia, and to like computer companies, and also to like chip makers like Nvidia and even TSMC. So they have an IPO currently
Yeah.
happening. Um, do you want to kind of like talk a little bit on what is happening with ARM at the moment?
Yeah. So you call it I call it ARM, right? So I don't know if it's called or ARM, but I know it's ARM. Like so, it's ARM, and it's amazing. Like the journey, and for me, so I followed the acquisition story closely when Nvidia was trying to like acquire ARM. That was like 4 5 years ago, right? But regulations they couldn't continue with the acquisition because of regulations, right? And also following up with the backstory about when SoftBank, bought ARM from the public market, because ARM used to be on the public market, right? But back then there was like, when I say there was little innovation, but there was like, they were on that journey to like, dominating the market, right? So SoftBank bought ARM from New York Stock Exchange and I think London Stock Exchange. So they were listed on two exchanges. We bought them, make them private, and started. I don't know what magic they did within that period of time, right? They did some magic, cooked, and now their numbers are like amazing, right? So this is a testament to the fact that when you like the arena suite or I'm in the arena trying different things. Yeah, try different things. I don't know what will work. Some will
Yeah.
work, some will not work. Yeah, so something like that. I think SoftBank is a testament to that. Like
Yeah.
literally everything they've been doing has been that. Like WeWork did not work, some did
Yeah.
not work, but this one that worked, like this bet they took, and it's a very sizable chunk, right? It means that
Yeah.
they literally went all in, and they brought them out of
The entire
public market.
company.
Yeah, they bought the entire company, not like they're buying a chunk or buying a part of the company. So it means they still understand this business economics, and what they're doing is great.
Yeah.
And it's interesting. I just want to also talk more about the IPO market. What are the other news that are coming in the IPO market? Do we think this is the right time for the IPO market to come back? Or do we think this is just a fluke that comes up and comes down, right? And it's also interesting to note the strategic listing, because ARM is only listing almost 10%, let's say 10% of
Yeah.
their, yeah, they're only listing 10% on NASDAQ, right?
Yeah.
And also, you can also talk about the fact that they also choose not to list on LSE, London Stock Exchange, right? It's a UK
Yeah.
company, right? They are a UK company, but they are not listed on the UK, on the London Stock Exchange, right? Which is
Yeah.
like a slap to the UK government. So yeah, do you want to like talk about or demystify all of those parts? Like, I know I've said a lot. So what do you think?
Yeah. I mean, ARM has come a long way ever since to um when they were bought by SoftBank in 2016, it was really a big deal because SoftBank at the time raised they had like a vision fund where they raised about $100 billion, and a lot of that money was actually from different parts of the world. $45 billion of that was from Saudi Arabia. They kind of like took a lot of bets on different things, and I think harm was one of the things they took a bet on. And it kind of like seemed today that they want to sell some of that equity, but it doesn't look like a sale, but because it looks like you're only offloading 10% of that equity to the public market, meaning that they really believe in what they are currently doing. And basically, ARM revenue in 2022 was like, I think 4.8 billion dollars, and their net income was like $500 million, which is a lot. And currently this year, their net income is like $600 million, and that is like within the first two half of this month. Their first income is like more than $600 million, with like probably like $2 billion in revenue. So which is great. Like net income is actually profit. So profit after tax. So which is great. Like for what these guys are doing, and it could actually talk a lot about like their valuation. They are currently going to a lower valuation that they've previously said in their current S1 filing that they just updated. Their current valuation, they are targeting about a $51 to $54 billion valuation. In the former X1 filing that was some months ago, it was like a $70 billion valuation. And that is because there's a lot of competition in the AI space, and there could be a bubble in the AI space also. But even as at then, like we could not really say the AI space is in the bubble in the private market, because in the private market, it's probably only Nvidia that has that has gained from that AI narrative over the past few months. Google, Microsoft, they didn't really gain so much because of the AI narrative. So we could only say that Nvidia is carrying the whole AI bubble in the public market. But in the private market, it's obviously there's a lot of liquidity in venture capital going into various AI companies all around the world. In Europe, in the USA, there's a lot of AI money. There's a lot of venture capital money going into AI companies all around the world. So it could be that ARM might not be a great company in the public market above like $100 billion like Nvidia, because it could be that there's a bubble, because obviously there is a bubble in the private market when it comes to AI, but in the
Yeah,
public market there's still some tailwinds concerning artificial
yeah,
intelligence.
yeah. I 70% agree with you, right? But ARM is not really playing fully in the AI space, right? They are enabling other people. So it's just like during the oil boom, where those selling shovels, those selling jeans, were the one like
Yeah,
making the money. So this is literally the player, right? They are the one, they design their licenses are designed to other
yeah,
people playing in the chip market, and the manufacturers manufacturing it. So I feel, and their margins are like crazy because they are not
really great
manufacturing.
margins. Yeah.
Yeah, they're not manufacturing. So it means that they have opportunity to make better margins. So you want to talk about the presentation you just put up? Yeah, yeah,
Yeah, so like the semiconductor industry is meant to grow a lot in the coming quarters, up to like 2026. These are like the current projections. We really don't know the further projections above 2027 to like the late 2020s, because there's a current notion on Wall Street right now that the phone market, which is one taking more of the semiconductor industry supply, is having a decline growth. So there's a decline growth in the phone market from Apple to Android phones, and that growth might have peaked. Probably the phone market industry might have peaked, and probably the phones we use today, the current iPhone 13, 12, 11, might still be used in the next 5, 7 years by the current users. So the phone market projection might not be that great for chips in general. But in the coming quarters, you will see some growth. Like we will see some growth, and that we can actually predict, because based on current orders of Nvidia chips and other companies like ARM, we could actually predict the growth in the next 2 to 3 years. But going forward, it will be hard to predict if the chip industry would see a lagging, because there is kind of like a draft in the smartphone industry, which is contributing more to the semiconductor industry basically, and even the computer also, like the smartphones. I mean, the computer, the laptops, and all produced by Dell, MacBook, and other brands. Like there might be some lagging decline in that market also, because we don't know how
yeah,
consumers are going to pay for forward. And also, like talking about forward guidance when it comes to coming economic situation going forward, there's high interest rate at the moment, which is affecting not just current purchase power, but also future purchase power also. Chinese also, which is like they are the ones paying more for smartphones globally. They are having currently what we call deflation, which is even worse than inflation. But in Chinese, deflation is even a bit um, peculiar, because they have a balance sheet recession at the same time, meaning that the average middle class is like paying a lot of debt, and they'll be paying that debt for the next 10 to 15 years because of the real estate crisis that they had. And due to that, a lot of Chinese were the ones buying like the first, the second, the third house, thinking that to be a good investment. Now it's not a good investment. A lot of them in debt. So stuff like the consumer electronic market might be lagging for the next 5, 7, 10 years in China and globally as well. So
yeah,
it's kind of like it will be a rough path for the semiconductor space, to be honest. Like it will be a rough path.
yeah. Yeah, so I just want to add to that, to just let's tread on a path of caution, right? In terms of we are now seeing newer use cases for for chips and semiconductors, yeah, especially chips, right? You see the way it's been applied. For example, before this AI bubble, right? I don't know what numbers Nvidia was doing, but the valuation Nvidia got within this AI space,
Yeah.
is in multiples. So the same way I expect there to be, newer innovations coming on board. I know, for example, this AI is a journey, right? For example, you
Yeah.
see the recent OpenAI financials that added, that their profits, bringing those profit. It's going to be a split profit within OpenAI and Microsoft, right? And
Microsoft.
these
Yeah.
are huge numbers. So I see with this AI bubble, I won't even call it a bubble. I would just say with this AI era, right? We would see
Yeah.
new use cases, new need for compute. Computing power has never been this
Yeah.
available, and people maybe it might not be that accessible for everyone right now, right?
Yeah.
But on enterprise level, it's going to be high, and you're seeing people putting money. Everybody's putting their money where their mouth is. VC
Yeah.
in the private, like you said earlier, the private markets already putting money into that space. So that is
Yeah.
what I feel is going to birth this new generation and birth this projection and make this
Yeah.
projection good. And let's also point to the fact that, fine, you might say phone adoption is on the decline right now, but there are also other embedded systems currently
Yeah.
on the market, right? We're now seeing different autonomous vehicles. Apart
Yeah.
from autonomous vehicles, they are home use
AVs. Yeah.
AVs, right?
I.
Home
Yeah.
home use device, like they're like I was reading about
Internet of
this.
Things. Yeah.
Yes, Internet of Things, exactly.
Yeah.
Like, different things you use in a home. I was reading about this electric, like a Roomba, like it cleans
Yeah.
your house, right? It uses all of these things like getting more advanced. And the more they get more advanced, you see a fridge talking to you, and all of that. And the more they
Yeah.
get more advanced, the more innovation gets more advanced, the more they get dependent on these chips to
Yeah.
make them,
True.
become faster. So I feel, yeah, we shouldn't like predicting on that, making projection on the linear pattern, it has always
Yeah.
been, shouldn't always be the case. It's new time where we start to see new new innovation coming on board, and that's
Yeah.
what is going to kick this projection. I won't be surprised by 2026 or 2025 when we're seeing projection for chips going as high as 2 trillion. Yeah.
Yeah. Yeah. Like you rightly said, like there are new use cases for chips. Like, for example, like you mentioned the EVs. Like the average electric car right now has about I think 7,000 chips in it, like 3,000 to like 7,000 chips. That is a lot of chips already. Compared to if it was a internal combustion engine car. And EV adoption is also on the rise because of also climate change movement and ESG policies, helping cars and helping electric cars to kind of like outsell internal
Yeah.
combustion engine cars. We saw that with Tesla and BYD,
Yeah.
overtaking some major automakers, already. So I think it's great. And also for the Internet of Things space, I think it's also great because a lot of people are relocating from the main city area because of high rents, prices, and because of remote working also, to kind of like start a new life in a smaller city or in another country, which can like give rise in also home appliances and home furniture is coming back again on the sidelines to kind of like increase revenue, that have been lagging before. So I think, yeah, there's a great potential for ARM to kind of like be the designer for that particular space for EVs and for Internet of Things and all of that. So I think it's great. Like you mentioned, a great point there.
Yeah, yeah. Thank you. So let's moving on from ARM. What other IPOs are you personally? Are you checking? Are you checking out?
Yeah,
Yeah,
I'm checking Instacart. Like Instacart is great. Like they've beat all estimates. over the past few quarters, they've made a $700 million revenue last quarter alone, and they kind of like hit a
Wow.
net income of $114 million. That's profit, right? And that is a grocery delivery company. So, and Instacart is great because they kind of like they're kind of like the home delivery service for Costco and a whole chain of other grocery stores themselves. Like they kind of like do the delivery for some of these companies also. So they're like the last mile delivery for a whole lot of companies. They don't just do like the connecting
B2C.
of like, yeah, like the B2C and connecting of like people with bikes taking delivering groceries and stuff like that. They do more than that, and I think they kind of like have plans to become even more than that. In the sense that they could even enter a larger space when it comes to delivery of not just product, but also packages like FedEx, UPS, Amazon type of packages in areas that are probably underserved, and probably enter new markets also like India and and probably even China if possible. But with all the numbers they have currently, Instacart is crushing it at the moment. Um,
Are
they are
you
really
are you
crushing it.
confident? Are you confident of the IPO debut? Because this is not the first time Instagram was trying to come into do an IPO. I think they attempted to do an IPO in 2021, if I'm correct, 2020 or 2021,
Yeah,
right? So, but then and now they're coming definitely going to be coming at a lesser valuation because and they also raised
yeah,
a lesser valuation round. And
yeah,
compared to other people on the market compared to their competitor like DoorDash, Uber. Now, Uber is
yeah,
100% in the market. If you come to London now, Uber is going all out on their groceries, right? You see ads
yeah,
everywhere on the tube, on the at major stations and everything, right? And there
yeah,
are also other players, right? But they are owned by these top companies, top FANG or top tech companies, right? For example,
yeah,
Amazon has Amazon Fresh, and they also have their own their own last mile delivery. We have Target also as their own. Target acquired a company recently just to be able to offer that. We also have Walmart. Almost
yeah.
all these big chains already have their own um, people already have their own product competing in this market. So, what do you think? How does that spell? Like, what does it impact on? How does it impact Instacart IPO debut?
Yeah, so I think Instacart already priced in into their current valuation. They raised in the private market, they raised up to a valuation of 39 billion, but now they sliced that valuation to 24 billion. And with the current market share that they have, like as you can see on the screen, they kind of like have a dominant market still over Instacart, still over DoorDash, and still over others. And it's kind of like declining, but I think they could in a public market they could have a lot of liquidity to play a good game and do well in the public market and writ large in with their top line revenue also. So
Mm,
I think it could actually grow up to that. For it was the same story with Airbnb, right? We There was like the hotels of the world and lots of hotel chains globally, and we felt like Airbnb's business model might not be sustainable because there could be back channels to the product
yeah,
itself. But
yeah,
eventually, Airbnb is still, even in the market downturn, still remain at $100 billion valuation. It only dropped like 80, but the median has been around $90 billion valuation. So I think it could be the same story for Instacart, right? Coming back up and even entering the services of DoorDash, like food delivery to like from restaurant to restaurant, not just grocery delivery, but also
yeah.
food delivery. They could enter that market and compete with Uber and DoorDash. I think there's a lot of upside for Instacart going forward. I think it's a stock that I might be even buying on IPO debuts. Because,
Ooh,
well, I think all the recent IPOs, except for
yeah,
Better.com, we should probably talk about that, has
yeah,
been bad. I mean, it has been great, except Better.com, which has been bad. But for obvious reason, Better.com has been bad because they deal with housing, and currently there's like high interest rate in the mortgage space right now. So, so yeah, so that's it for my take on Instacart. It's, for me, it's still a great company actually.
yeah.
Yeah,
Great, great.
still.
Uh, yeah. For Instacart, that's a good. Those are good numbers. Those are good numbers, right? And I think the boom also came during COVID and all of that. But yeah, do you want to talk to this presentation?
Yeah, it's Instacart growth sales. Like these are their sales in billions. But I think more of that percentage is like it's not as if this is like they made $35 billion, but it's like the probably TPVI. Let's put it that way, like the TPVI of what they've made in transactions. So it's like increasing every year, and at a steady pace. It's increasing every year. So I think that's like the great story about the Instacart narrative, uh, writ large.
Great, great. So for me, the only thing I'm 100% like, it's not like it's not like if I'm against them, their IPO would
Yeah,
succeed or the IPO will go on as planned, right? So my only concern has just been the fact that IPO markets right now is very tricky, and now
yeah,
if you're going to the IPO market, you need to come correct. There's no,
yeah,
it's like it's past the days of bubbles. It's past the days of time when you have to like plan or like prop your stock or prop your market. You have to come correct. The markets are not dealing with they're not going to deal with you fairly if you don't come correct. But I'm really looking at Instacart, looking at people the company leads, the people their CFO was ex Goldman Sachs, the person in charge of their products was like ex Meta, and they also currently they've had some companies like already ready to like take ready to like buy their shares like their stake as they're coming into the market, so they already committed capital right there. I feel that gives them an extra edge, an extra advantage, so they are only going to be doing like a little bit of this, just same way ARM tries to play safe, bringing just 10% of their words on the market. So I feel Instacart should also play safe that way and also have a better show. But we're going to know in the coming weeks. So I think we should
yeah,
wrap up on IPOs, or else we're just going to talk only about IPOs on this episode. Or do
yeah,
you want to just talk a brief about Better.com? Just give us like an interval.
yeah.
Yeah, IPO
Better.com.
show.
Better.com is like a online mortgage financing company. Basically, you can refinance your mortgage there. It's like a marketplace. You can like refinance your mortgage. Or we could say also it's like a fintech also. But they were planning to have an IPO in 2021, worth at a valuation of like I think they were valued at 7 billion back then, and have an IPO as at then, when that was like when interest rates were low, and they couldn't probably really predict that interest rate could actually go up, and it did actually go up, and that was the time liquidity went out of the system. They couldn't have that IPO, but they claimed they had $500 million in profit at the time, which was understandable. Like it was very possible for them to have $500 million in profit back then in 2021, because everybody was refinancing their homes. Everybody was taking those cheap debts at 0%, 1%. So now interest rate is above 5%, which is high. For mortgage, it's even above. I think it's even above 7% for the mortgage space. So it's nobody's refinancing their home on 7% anywhere in the world right now, because it's really hard. Like the mortgage or the real estate space, both commercial and residential real estate, is really, really suffering at the moment in the United States. And it shows how cyclical the business of real estate could be also, especially in relation to high interest rate or low interest rate. So the stock went down. They went on a spark. They went public on a spark. The stock went down by 90%, and that's about it. It's still trailing around 90%. They went 90% down on debuts. So compared to like Vinfast that went, I think that went to like a huge market cap within like the first few days of the IPO, still on the spark, you know. For Better.com, it was a very different story, and they have also had bad PR also over the past few years, over the past 2 years actually, with their CEO, the way he handled firing staffs and all of that was really really bad. They took a huge hit, and people went to competitors to leave the brand to go to competitors basically. But yeah, we could talk more about other things. I think um, there's an interesting story I saw on Twitter. It's a guy called, he has a company called TeamShare. I don't know if you've heard about it.
Yeah, I read the
You,
story.
yeah,
Yeah, so it's a very tricky one. I wanted us to like break it down on the podcast. Why?
yeah.
Because maybe maybe you should give like an overview. Then I'll ask my question because I have lots of questions.
Okay.
Yeah,
So
let's see.
yeah, so TeamShare is a venture-backed private equity firm. Like we won't, they don't call themselves a venture-backed private equity firm. They call themselves a venture-backed startup or a venture-backed fintech, and you will know why. But a lot of people see it as a venture-backed private equity firm because their business model is basically taking money from venture capitalists and buying small pop and shops, mom and shop, mom and pop shops businesses that are making between $1 to $10 million in revenue, buying them probably at like 20, $30 million, and kind of like using that as like their chain of businesses under that startup. So overall, they are probably making they've bought 80 mom and pop shops so far that are making between $1 to $10 million. So already they'll probably be making around 80 to um, probably 80 to even 150 to $200 million a year already with those 80 companies, and they're probably still buying more because that revenue coming from those 80 businesses is going to buy more businesses and going to buy more and more businesses and grow that, so that's what they do. They get money from venture capitalists, they buy businesses just like the conventional private equities structure, which take money from LPs, buy private businesses, and grow those businesses. It's the same strategy they are doing here. And I think, but for them, it's a bit peculiar because they call themselves a fintech company because they, at their core, they have fintech products that they onboard those 80 businesses to use those products. So from the
Yeah,
invoicing, from the credits, from literally everything. So
yeah,
when it comes even to revenue, it could even be more than that with those. It could be more than $200 million with those 80 companies they have in their portfolio,
yeah,
which is great. They don't plan reselling those companies like the traditional private equity firm would do. They kind of like plan keeping those companies, and some of those companies, I think they're coming in. They're buying them at one of the best moments
at the
in
discount.
history.
Yeah, the
Yeah,
yeah,
and they're buying it one of the best moments in history, not just because of high interest rate that is making those companies to sell cheaper, but also that the people that they're buying it from are retirees, basically. Like, I don't know if you've heard, Ray Dalio has been talking about it. It's called the Great Wealth Transfer, talking about how baby boomers are retiring this decade and obviously passing away, and they'll be selling off businesses, millions of dollar worth of businesses, because they are the most successful generation in history, and there's a ton of businesses attached to them. There's a ton of wealth attached to them, Baby boomers' net worth all around the world control about $80 trillion. Some estimates say it's
Wow.
around $100 trillion. So a lot of them will be passing down those businesses either to their kids or to actually resell those businesses because their kids might not even want to continue those businesses. So they're
Yeah.
coming at one of the best time in history to acquire very, very quality businesses. Among some of those quality businesses, they are coming from about 40 different industries, from restaurants
Yeah.
to manufacturing to pharmaceutical to
Yeah.
ATM machines, to things like that basically that are very good at generating cash flow. So I think that's like the story for these guys, which is a very incredible business model that could be replicated in other parts of the globe. And I think it's begged the question of how we could even re-strategize venture capital to be more structured like private equity also, um, which is great at the moment.
Yeah. 100%. I think you said it all. Like you said everything I wanted to say. I was going to say, yeah. And it's interesting because the guys running this company are like investment bankers or ex-investment bankers. So they're very smart and they're able to like structure a deal like this, right? I find it surprising because I find it interesting because it's a venture-backed company. Like a venture-backed company is not supposed to like. I know there are a lot of venture-backed companies that they have their own fund, like even public companies have their own fund that they used to like invest in other market,
Yeah,
but they are a venture back firm also investing in other firms as well, but their mission, so to say, is not really buying businesses. That's just their business model. What they're trying to do is that they're trying to like give ownership. That's what they're literally selling. Because I checked their website, I went to Crunchbase to check what they're doing and try to get it out of the deck. They're trying to sell these. They are trying to sell ownership. So what they do is that they buy these companies from these mom and pop shops, and they give 10% on acquisition. They give 10% to they share 10% amongst all of their employees, the employees of that company, and they do like a time like a 20 years or 10 years timeline where they reallocate 80% of the company's worth to the employees there. So they're like a wealth reallocation kind of thing. That's the
yeah.
message they're selling. Yeah.
Yeah, it's a very good message when you give out equity to employees because it incentivizes them to be serious with the business, to grow the business. Because that team share, that company called Team Share that is acquiring all of these companies, they won't be able to manage all of these companies because some would be in different geographical regions or even in different continents, and it'll be hard to manage such type of portfolio when you're not a big private equity firm like KKR or Carlyle. So yeah, like when you incentivize people to do a good job, they would actually do a very good job, and because they have equity and ownership in that business, and meaning that it's now their own also. It's not just the company's or the owner's business. It's now their own business too. So there's a whole lot of logic why they are doing what they are doing.
But I have questions.
Okay.
Yes, I have questions. So one of my questions would be, and one of the things they mentioned also is the fact that they're also buying similar businesses. For example, they mention a pizza shop. So for example, buy
Yeah.
a pizza shop in a location, buy another pizza shop in another location. Then if they bought, let's say 20 pizza shop, they can bring all of those pizza shop under one brand, right?
Yeah.
And make them together. So my problem comes from when we start having issue like industry focused issue, like industry focused cyclical issues or challenges. For example, let's say like what is happening to the real estate right now, or
Yeah.
what is happening to consumer products, or what is happening to right, and they're not well diversified. Even if they're well diversified,
Yeah.
right, and they start building, industries, they start building companies like moats or bigger companies out of smaller shops or smaller like
Yeah.
distribution channel and all of that. At what point do they start having all of this kind of issue, or how can they mitigate, or
Yeah.
how can they mitigate that kind of risk?
Yeah. So generally, that's where the concept of diversification comes in. because the concept of diversification protects you from concentration in one type of industry, right? If you have two type of industries in your portfolio, you might think you're diversified, but some of these industries might be interrelated. You could have banking and real estate, and banking and real estate are susceptible to high interest rates, and that is not really a good diversification. That is still concentration in financial assets. But when you have, like, they have, according to them, 40 type of industries, that is a good diversification because the economy is so strong that if 10 industries go down, there will be 10 industries that will still do well, right? During COVID, healthcare did well, um, hotels didn't do well, but gaming did well, social media did well, internet companies did well. So diversification is I think is the edge for them, and they could actually gain a lot of risk reward adjusted benefit from this actually.
Great, great. I think we'll keep checking up on them, and I'm wishing them all the best. Like, it's a perfect model, it's a good model, but I also feel like if it's good, like somebody would have done it in the past. I know
Yeah,
KKR, and there are a lot of companies doing it at a larger scale, but in terms of mom and pop
yeah.
shops and all of that, I've never. This is the first time I'm seeing something like that. It's really amazing that it's coming from them. So yeah, so I think
I
that's
think people are doing it.
okay.
I
I
think
know people are doing it in terms of venture studio, in terms of in different ways. But in terms of this
yeah,
particular style, that's what I'm saying. Like, this is my first
yeah,
time of reading about this particular style.
yeah. It's like the first of its kind, but I think even conventional private equity firm are doing it because in the private equity space, it's a very huge industry. So if you enter in the private equity space, you are competing for very few good private companies and very large good private companies, and there are very few of them. But in the space, and that is between the space of $100 million in revenue to like some $1 billion in revenue. But in the space of below $100 million in revenue, there are thousands of private equity players. I think there's even room for like more to come, and these are the people financing private equity deals in that space, buying up small mom and pop shops in those spaces. And even for them, the private credit space for them is played um, in that space between below $100 million and all of that. For larger private equity firm, they do private credit deals above $100 million, but sometimes even $50 million companies and all of that. So for me, I'm curious how it could be replicated in other parts of the world, um, because there are a lot of good small, mid-sized businesses in Africa, in Asia, in the Middle East, in Europe, and even Europe right now is even facing a lot of headwinds when it comes to financing, high interest rate, and recessions and inflation. UK, Germany, and these are like the people suffering more in the eurozone, even if UK, well, it's not really in the eurozone, but it's in Europe. Um, Other parts of Europe might not suffer, are not really suffering as well, but yeah, like the major big economies are suffering, like Germany. Um, so yeah, it's. I really wonder how it could be replicated there because there will be obviously good businesses in these places also.
Yeah, 100%. I 100% agree with you. So that's what I'm saying. I would love to see more replication of this, right? The fact
Yeah,
that they take 100% ownership, so they actually buy out the company and, like,
yeah,
install a VP or install a, so that's what I'm saying. So it's really good. I would love to see more of this. I think that's everything we are set to discuss today, right?
yeah, yeah,
And this kind of, it feels kind of good. Like, it's not that bad. I
yeah,
was actually dreading having a video podcast. Like, oh my god, my face.
yeah.
Oh.
Pe-
But I don't think it's
yeah,
that bad, right? And this is
yeah.
the first
People are
one,
not
first of
used.
many.
Yeah, people are not used
Yeah,
to do this video call on Zoom, Google Meet. So
yeah.
I get that feeling also,
Mm,
but it was good.
okay. Yeah, I feel it was good. So looking forward to having more topics, more range of topics, more conversation. If there's any topic you want us to deep dive into in the
Yeah,
private market, in the public market, even in the startup market. So I feel now going forward, we'll be adding some startup conversation because
yeah,
I play in the startup space, right? No, James also play in the startup space, but private equity interests him more. So I play in the startup space. So I think we'll start talking
yeah,
about
true.
startup, talking about startup valuation, even talking about obscure startups that you've never heard of.
Yeah,
So in the nearest future. So you guys should look out, and thank you for watching. Make sure you like. I think we have to say that now. Make sure you like and subscribe.
yeah, true, true. And if
It's
you want
so
to feature
weird.
your startup also, like if you want to feature your startup also, you can reach out to us.
Yeah, yeah, definitely. We can do like a pitch deck tear down. That's something we also wanted to do, like a pitch deck tear down. Look at your
Yeah,
pitch deck, talk about it, talk about different aspects of the pitch deck,
yeah,
and yeah, that's it.
yeah. That's
Any
it.
last word, James? Any last word? Any final
Um,
words?
no, no, no last word. But
Nothing.
it was a
Okay.
great one. Thanks for being part of this all
Yeah,
the time.
I enjoyed it. So that's it. As long as I've enjoyed my podcast, I'm
Yeah,
fine. Thank you. Bye.
yeah. Goodbye. Take care.